Hello everyone and welcome to our Down to Finance podcast Australia with our special guests Brendon and Sarah. Thank you guys for coming in today. Today we're going to talk about one of the biggest topics that we've been discussing with our clients over the last, fortnight, and the changes to property investing and what that means for our everyday Australians. If you've been watching the news lately, or any social media, output, you've probably heard terms like negative gearing, capital gains tax changes, established properties, new builds, and investor uncertainty. The reality is we've received probably a few phone calls, a few late night phone calls, messages and emails of clients all asking the same question, all feeling the same way. And the answer is property still worth it? And I guess the answer is yes. The rules may be changing, but there are still incredible opportunities available for investors. Investors just basically have to have the right strategy, the right advice, and that's what we're here for. Today, I'm obviously joined by our senior mortgage brokers, and we're going to discuss it in a bit more depth. So I might pass it over to Sarah to kick off.
Yeah. So I guess today's obviously just talking about how everyone's feeling around the changes and explaining those changes. Probably the feedback that I am getting is there's obviously a lot of fear out there because everybody's talking about it, like what you mentioned, social media, it's snippets of the information, which I think puts a lot of fear out there. But I don't necessarily think that we need to be scared.
Mm-hmm.
But I guess with any property investing, like it's always changing. There's always lender policy changes, but it turns around and changes all the time. So I guess it's just evolving in another way, would be probably how I would explain it.
Yeah, there's always going to be like pros and cons for buying an investment property. We weigh them up and then we work out what the right strategy is for you.
Exactly.
So I guess there's interest rate changes, but interest rates have gone like this. Obviously we had 2019 to early 2020, we had COVID, we had record low interest rates, and then post-COVID, I think we had 14 rate rises, which significantly put the fear in a lot of people, not just investors, but owner-occupiers as well. We're always going to have government changes. We're always going to have lending policy changes. But I think Australians have continued to build good, strong wealth through property, and that's what we've got to keep reminding ourselves
Focus on that, yeah.
All right. So in terms of obviously like an ideal investor right now is who, Fredo?
Ideal investor at the moment is probably someone that is wanting to look at a new property.
Yes.
The reason for that, obviously the lending landscape has changed.
Yep.
So we can no longer use negative gearing effectively. Previously, before the changes, negative gearing would almost allow income be added to your normal income.
Taxable income. Yep.
So it would allow you to borrow more. Now that has been taken away and only valid for new properties. Investors are going to have to move towards buying new because of the lending changes in line with the government legislation.
And the borrowing capacity and so forth. So I guess for everybody out there listening, as a mortgage broker now, we have received policy updates from almost all lenders. So we work with about 40 different lenders. They've obviously put in black and white writing, this is what we can do, this is what we can't do. The servicing calculators almost instantaneously that week were updated and changed. Some lenders have come out, however, and said that they will still honour negative gearing until the legislation changes have become effective. But I guess obviously just so the audience understands is previously we used to get to tick in our servicing calculator that it was an investment loan and that it was tax deductible. And now when we do a servicing calculator, we have two different boxes. We have new, so there's a little box that we get to tick, and then obviously there's established. So pretty much we now have to untick that if it's established, we don't get any negative gearing for that servicing calculator. So I think it's really important to remember that successful investors don't stop investing when rules change. They just adjust their strategy. So if we do look back over the last 15 years, obviously I mentioned COVID, but we've also had significant changes with APRA. We've had rising interest rates. We've had falling interest rates. We've had changes to invest in lending and countless policy adjustments. Yet the clients who stayed focused on long-term wealth creation have generally come out ahead. And I know there's a lot of clients out there at the moment that are sort of like sitting on the fence thinking, do I take that step? Do I hold off? Do I wait? What do I do? And yeah, I'll get your feedback again, Fredo. Like, what are we sort of going back to these clients and saying, and what's sort of our perspective on that?
Well, it's the difference between buying investment property and not buying an investment property. And investment property might not be the right strategy for that person right now. They might look at other investments. That's totally okay. But moving forward to most likely achieve them getting investment property, they are going to have to build or buy new, which has its advantages within itself. So depreciation, so they get that comes off their taxable income. The property's new, so less maintenance compared to older properties. Like I personally have got an investment property in Queensland. It's a weatherboard. It's humid and rainy up there. Those weatherboards cost a lot to fix when it's an older home.
Yes.
And when you do build, you've got the luxury of a builder's warranty. And one thing that a lot of people...
Appliance warranty as well.
Appliance warranty, all those things for your Miele stove. One of those, or one advantage that people sort of do forget about a little bit is tenants do like a new property. So they're willing to pay more rent at times because it's brand new, shiny. And they also don't have to worry about the landlord upkeeping the maintenance because it's new, because that's a thing as well. You see in the media all the time, you know, the old renter versus landlord ongoing saga.
Battle.
Of, you know, the landlord maybe not being able to afford the repairs, the tenant, you know, stating it's required by law, which it is. So having a new property does take away that little rub point.
Yeah. And I guess like obviously the rental yields on a brand new property, generally speaking, are going to be a little bit higher as well, because you get that, you know, person that's moving in that's prepared to pay that little bit extra for the luxury of having something freshly painted, new carpet, amazing appliances and so forth, air conditioning.
A new build as well is generally like in one of those growth corridors as well where, you know, infrastructure is still being built and things like that. So there's definitely more room for potential growth in terms of, you know, equity, etc. Which is a bonus.
Yeah, absolutely. So I think most importantly, like our role as brokers is now more important than ever, because not every lender is treating investing the same. So our job is really to like navigate for you what the right option is. And as, you know, Fredo pointed out, like there's so many benefits of still buying brand new property. And like a lot of the, I guess, value add needs to be spoken about right now, because, you know, just because established is sort of almost taken off the table, not for everybody, but for some from a servicing point of view and a borrowing capacity point of view. So don't think that we're saying that you can't buy established. We're just saying that your borrowing capacity is going to be different for the two different property types. And in terms of obviously new homes, I think they need to be spoken about in more of a positive way, because there's so many value adds as a landlord to still invest in these. In terms of our approach, like what works with one lender right now might not work with another lender. And like we always say, we never leave any stone untouched. And I think that's really important for wealth creation. We just have to be super creative right now. And if you do want to keep, growing your portfolio, we do have to diversify and use other lenders. Like, how many new lenders have you used like in the last probably 4 or 5 months? Like, we're talking to so many new banks, aren't we?
Yeah, that's right. And that's, not just in the investor space, like interest rates are high.
Yep.
The lending landscape is changing by the day. So whether it's owner occupied or investment, we're looking at different banks because, not every client is the same.
Yep.
Take into consideration over time, maternity leave, self-employed, how long they've been self-employed for. So, it's not just the investor profile that we're looking at different lenders for. It's across the board at the moment.
Yeah. And I guess obviously the government's objective has been made very clear that they want to obviously, adapt housing supply. So they want more homes being built. And because of that, obviously new properties are the ones that are going to continue to receive a lot more support from policy and tax perspective. So I guess if you are out there thinking about like, investing in new property, then we can definitely go through with you, your borrowing capacity, go through like the pros and cons and, potentially introduce you to Patricia, our property expert who works all over Australia that can potentially, help with, I guess, doing a bit of a property profile on you as an investor, and then recommends, state most importantly, and then suburb from there. And as Sarah previously mentioned, new builds generally are in newer suburbs, and obviously good old Melbourne. I'm not actually sure where are we investing out in Melbourne, like, it's a bit, but in other states, like what they do really well is they do infrastructure very well. Like they do, the schools, the roads,
the shopping
centers, parks and recreation, stuff like that is really good in other states. So obviously it's really good to work with somebody who's so diverse across all of Australia, not just obviously one particular state. So I guess we'll probably see a lot of clients doing interstate buying as well, would you say?
Yeah, we've had a lot of success over the last few years through Patricia and PCA, in Queensland, South Australia, WA, and it's all about, the right property at the right time. So they sort of, have their finger on the pulse with the property clock and link in with us and help the client get the right property.
And not to mention the cheaper stamp duty in other states as well.
There is cheaper
Absolutely.
stamp duty.
Yep. And you're only paying stamp duty on the land value. Obviously there's so many positives about purchasing a new property. You've got property as a modern, you've got the energy efficiency, as you mentioned, the low maintenance, you've got the growth corridors, you're getting the tax benefit, and you're buying an asset that people genuinely want to live in and genuinely are probably house proud, which means that they're going to take care after your home. So yeah, as we said, Patricia and the team at PCA do that really well, and vacancy rates on these suburbs as well. Obviously, they're things that she'll investigate too. In terms of going back to negative gearing and borrowing capacity and all those other things, what would we say is if a client comes to us and they're not able to do anything right now, whether they're self-employed or PAYG and they're wanting to buy an investment property, it doesn't mean that we can't help them, does it?
No. Not at all.
And we want to build a strategy for them. We put them on an action plan, and obviously we tell them X, Y, Z. If you meet these obviously benchmarks, then you'll be able to.
Yeah. Yeah, we definitely work sometimes, for long periods of times with clients to put a good strategy together to get them there.
Mm-hmm.
Yeah.
And from start to finish, Fredo, like if we met a client, say today, how fast or how slow could that investment journey be? Like from a client that is eligible in terms of borrowing capacity right through to settling their first investment property.
For a new build, from start to finish, you'd probably be looking at 9 months because you've got to build the home.
Yes.
Not a magician. that is one big
Can't
part
click
of it.
our fingers and make the magic happen overnight.
Oh, I'm doing some renos at the moment. I'd like to click and make that happen really quickly. But yeah, there's obviously the build process. So from once we first engage with the client and get the documents, we can have their serviceability and what's achievable to them within a couple of weeks. We then introduce them to PCA if they're going the new build route, which would be ideal. Good to have a team around you.
Yep.
From there, Patricia would, source a property, see what's out there or what's coming up. But we'd probably be looking at sort of a 9-month from start to finish time frame.
Yep. Excellent. And then Sarah, if it was a client that wasn't eligible, like for instance, might be on, say maternity leave and not going back to that same employer, or they're self-employed and had a little bit of a lower taxable year, like how soon could we turn that file around and get them into being eligible to buy their first investment property?
Well, I'd say for self-employed, it would probably depend how close we are to the next financial year.
Which is right now.
Right now.
So all you self-employed people wanting to buy.
Chat to us before
do not lodge just yet
your tax returns. So yeah, that's something, a big point that we make as well. Like we work alongside with the accountant and things like that to try and ensure that you are ready to have all our ducks in a row and things like that. So yeah, I mean, depending on the time frame leading into having your next lot of tax returns done, but it can be within a month. I mean, or it could be within, depending on, even a PAYG client, like it, depending on what the constraint is, it can be very soon.
Yeah. Yeah. And so I think like you're not going to be, pushed away from us if you aren't eligible right now. Like we can work with you up to a year, 2 years to put you into a position to be able to do that. And I think more now than ever, like Fredo mentioned, like to try and have the financial experts a part of your pie or a part of the puzzle. Like obviously the landscape has changed and we're going to adapt to that, but having the right people around you and to support you to make those investment decisions, your financial planner, also having your accountant, and then us on board trying to achieve that end goal of wealth creation is really, really important. I think in terms of like finishing off, we just really wanted to highlight that property investment isn't dead. I think that obviously there's been quite a lot of fear online around this, and we wanted to do a podcast just to obviously highlight also how much benefit is still left in our market. And right now I would say that there is so much opportunity there.
The population growth is always obviously increasing. We have housing shortages, so people need places to live.
People need places to live.
Yeah,
100%. And, I think the, hierarchy is to have like a safe place to live. Like it's a real goal of everybody, like whether it is owner occupied or, living in someone's investment property that's, potentially brand new. The families of today want that safe place. So I think, just going back to closing, like property investment isn't dead. I think, yes, the rules are changing and evolving. Most importantly for us, we are reading absolutely everything that comes out like from the lenders in terms of policy changes. So we're across all these legislation changes. Like, it's really important right now that we don't miss anything and that we're keeping up to date, because if we're not, it means that we might miss an opportunity with a client and we're unable to help them. So as Brendon mentioned earlier, like speaking to multiple different banks and multiple different lenders about policy changes and things like that is really important. Investors who educate themselves and surround themselves with the right professionals and adapt their strategy will continue to create wealth. Agree?
Absolutely. Yeah, it's team effort.
I think if you're wondering what these changes mean for your personal situation, then definitely reach out to our team. Whether you're a first-time investor or a seasoned investor, or just simply trying to understand what your options are, we are here to help. So, sometimes we can be dealing with a client that's got 5 investment properties. Like right now, I was doing a servicing calculator with a guy that's got 5 investment properties and purchasing his 6th. And that is one complicated servicing calculator right now.
Very busy.
Right now, we just need to get all the information from the clients and put it all in, and then obviously work it out and workshop that out. Because, hopefully there's always going to be some sort of solution at the end of the tunnel. So we just wanted to say thank you so much for listening in again. And thank you to Sarah and Brendon for talking all things investment and recent changes that are happening. There is more to come on this over the next 4 to 5 weeks. So stay tuned, and we'll look forward to speaking with you very soon. Thank you.